Welcome everyone to another episode of Mere Finance. We have finally good news. The good news is that Treasuries are acting as the way it should be. The whole financial system backbone are Treasuries. And when Treasuries don't act as a safety asset during risk-off times, then we have a disconnect on the market and on what the Fed Reserve is doing. So Treasuries, the phoneix is finally rising again. So to analyze this, we need to understand that this is the most important graph in finance right now. Equity and bond correlations. This is the 3-month rolling weekly returns. Look how it has been significantly negative for 2021. And then 2022, it went up all the way to 0.8%. That's unbelievable. Equities acting like bonds and bonds acting like equities when they should be totally negative correlated. So when risk on and risk off behavior comes to place, then investors can properly hedge or diversify. But when you have, like we see here, in 2022, almost at 8 correlation, then that's a huge issue for investment strategy, for modern portfolio theory, and for subsequent returns. So March has been the most important month for the market since August of 2020 because of this graph of correlations going close to zero or negative. And the flight to safety behavior of Treasuries against a volatile sequence for stock is back, which is what we need. This failed in 2022. So for the banking crisis to be over, long duration Treasuries must rally to fix the collateral damage that happened last year. As rates were going up, Treasuries just collapsed, especially long duration Treasuries, and they collapsed at the same rate than stocks, which is never the case. Stocks should rise, Treasuries should rise less, and when stocks drop, Treasuries should drop a little or go up. And the thing is, like in 2022, the US bonds hit a new historic lows. It's completely black swan. You have the worst performance for bonds since 1994 and even since 1842. Look at intermediary term US Treasuries, so from like 5 to 10 years, negative 10%, total bond return, negative 13%, long-term Treasuries completely wiped, and negative 29%, surpassing what happened in March 1980. And then for long-term investment grades, negative 27%. Not even since 1842, pre-Civil War times, we hadn't seen those returns. And this is also very important to note, the VIX is still at 20. Even after banking crisis collapse, even after we have the 40-year-old inflation, highest inflation, even after interest rates raised at the highest pace ever, the stock market is still very resilient. VIX is still waiting for another credit event that will completely turmoil the markets. But the collapse of regional banks is not one. And this is what we're going to. This is another important graph. Look, when the S&P 500 total return, this includes dividends, which is the gray bar, goes negative, usually the 20-year plus Treasury bond goes positive, or at least they have less correlation. Look at the 1973. Yes, the S&P went down 44%. Yes, the Treasury bonds went down 8%. But that's a significant difference, right? Also in the 68, S&P down negative 32.6%. Treasury bonds negative 14%. Still not as much. But if you look at 2022, the bond market went down negative 29%, while the stock market went down negative 24%. Unprecedented. So in this 2023, in March, we're finally seeing that everything is going back to normal. Treasury is acting as a risk-off safe assets as the stocks start to go down. So we need those correlations to start going to negative again, to have proper investment theory, proper investment functionality, and proper financial markets. So thank you for watching. Let us know what you think.